Hello everyone, and welcome to Accounting and Auditing Hub. Today, we are tackling the beast of revenue recognition, IFRS 15. This standard completely changed how companies report their top-line income. It replaced rule-based guidance with a single, principles-based framework. I am Suresh Periyasamy, a triple chartered accountant. Whether you are studying for your CPA or preparing financial statements, I will guide you through the famous 5-step model. Let's start with the heart of the standard. The core principle is simple. You recognize revenue to depict the transfer of goods or services. The amount should reflect what you expect to get paid. But the magic word here is control. Under the old rules, IAS 18, we looked at risks and rewards. Under IFRS 15, we look at the transfer of control. Keep that in mind. Control is king. How do we apply that principle? We use the 5-step model. You must memorize this order. Step 1 is to identify the contract. Step 2 is to identify performance obligations. What did you promise? Step 3 is to determine the transaction price. How much? Step 4 is to allocate the price. Split the money between promises. Final step would be recognize revenue when you do the work. Step 1 seems easy, but IFRS 15 is strict. A contract only exists for accounting purposes if it meets 5 criteria. The most critical one is probable collection. If you sign a $1 million deal with a customer who is bankrupt and likely won't pay you, you have zero revenue. You cannot record revenue if collection isn't probable. It protects the quality of earnings. Step 2 is about unbundling. If you sell software implementation and support, is that one big thing or 3 small things? We look for the word distinct. If the customer can benefit from the software on its own, and the installation isn't heavily customizing it, then they are distinct. You must account for them separately. Step 3. How much? This gets tricky with variable consideration, discounts, rebates, or performance bonuses. IFRS 15 says you must estimate these up front. But there is a constraint. You can only include the bonus if it is highly probable. You won't have to reverse it later. Be conservative. Step 4. The math. If you sell product A and service B together for a discount, how do you split the revenue? You must use the relative standalone selling price, SSP. If product A is usually $80 and service B is usually $40, the total value is $120. If you sell the bundle for $100, you allocate that $100 based on the 80/40ths ratio. You can't just dump the whole discount onto one item. Finally, step 5. When do we book it? There are 2 ways. One method is over time, like a construction project or a cleaning service. You book revenue progressively as you work. Second is point in time, like selling a car. You book it all at once when the customer takes the keys. Control transfers. You must meet specific criteria to use over time. You can't just choose it because you want smooth earnings. A quick note on presentation. Principal versus agent. If you are Amazon selling your own goods, you are a principal, book gross revenue. If you are just connecting a buyer and seller and taking a fee, you are an agent, book net commission. Also, watch out for contract assets. This is when you've done the work but can't bill the client yet. It's different from a receivable. IFRS 15 is complex, but it ensures revenue is consistent across industries. If you need help mastering these steps for your exams or your job, feel free to reach out to me at spidvisory.co@gmail.com. Thanks for watching.